bad news for you, my friend. All good things must come to an end. And here on the Retirement Answer Man show, I'm afraid that this is the last episode focusing on annuities. We've been doing a deep dive into annuities, trying to take a fresh look and get beyond all the hyperbole that's out there. And today we're going to answer some of your questions. We will come back and visit this in the future. But this is it for a while. No more annuities after this. But don't cry, don't cry, don't cry. It's going to be okay. Welcome to the Retirement Answer Man show. My name is Roger Whitney. I am your host. And although we won't be talking about annuities for a while, we will trudge forward trying to help you not just survive retirement, but to rock retirement. So let's get on with the show, but we can't do anything until we have that all-important disclaimer. Yeah, it's okay. Real quick, this is Helpful Hints in Education, and it should be obvious that you don't want to take specific advice from me, and I don't offer it to you. We're just trying to give you some helpful hints in education, let you share some of the experience and wisdom I've learned along the way. So before you make any decisions, talk to your legal advisor, your tax advisor, or your financial advisor, because that's how you're going to make a better decision. And with that, let's get on to the hot topic and set up what we have to come. To help you deal with the grief, sadness, and melancholy that may set in after this last annuity episode, well, I wanted to throw you a bone. I wanted to give you something to look forward to. And that is our topic for all of August, which is going to be about who are you in retirement as you transfer or you go through the closure of the season of your professional career and enter a brand new season. How do you discover what your new identity is? In my experience walking life with clients, I find that transition into retirement, although it's exciting, can be a time of stress and anxiety as we're realizing a lot of our identity is starting to fade from a professional standpoint. And we are faced with who are we going to be for the rest of our lives? That can be really intimidating. And so I think it's an important topic. And I'm going to be honest with you, not that I'm not always, but my personal feeling is this topic for August may be one of the most important themes that we've had the entire year. This is a big one because it's a life thing, right? You're trying to figure out, yeah, you got your go-go years, but you got a long time in retirement. It's not just simply a small season. It's a whole third of your life, potentially. And part of the issue with that is we're dealing with a blank canvas. When you leave your full-time career and as you wind down parenthood or certain roles in your life, you have a blank slate, right? It's the first time since college you can organize your life any way you want. You don't have to live where you're living because you don't have the commute that you might have had. Maybe that's why you live where you live now. You don't have to worry about school districts if your kids are of age and they're out of the house, so that's not a big issue anymore. You don't have to have your social network defined by your kids' network or your work network. You're free to create any kind of social network you want. There's not a lot to constrain you. But the problem is we're really bad with blank canvases. One of my favorite men who I read often is Seth Godin. He said recently that people are good at A, B, or C. Meaning, here's door A, here's path B, here's path C. They're good at choosing with a framework of, okay, this is how I'm going to live my life, or really with any choices. They're not that good at pick any card, and people are terrible at think of a number between 1 and a trillion. And his point is that when we have this blank canvas, it can be intimidating and we don't know what to do. So absent intentional thought, we are just going to opt for what we know, even if it's not really our true, authentic self. And that is a big issue I see people dealing with as they're moving into this new season of life. And it impacts everything from financial decisions to your life, to your relationships. So we got to make sure we talk about that. So we're not going to be as nerdy as we were this month on annuities, but we're going to be a different kind of nerdy. We're going to be like an EQ nerdy. We're going to get in touch with ourselves by having a conversation for the entire month of how do we navigate this so we can start to create this new identity. And I want to give you a framework so it doesn't feel like it's just such a blank canvas. All right. So don't be sad we're not talking about annuities. We got a whole nother thing to focus on to help you rock retirement. And with that, let's go to practical planning where we answer your questions. So in today's practical planning segment, we are going to dive into your questions about annuities. And to help me along with this is Nicole Rockstar Mills. Hey, Nicole.
Hello.
All right. We're being professional in practical planning. So what we got going?
Our first question is from Brian. And he writes in, why wouldn't individuals just self-annuitize using the IRS RMD tables, thereby keeping control of their assets with the additional benefit of being able to leave the assets as an inheritance?
I think that is an option. I mean, I don't know if you'd call it self-annuitization. That's basically what an IRA is when you have to take required minimum distributions. The difference, though, I think, Brian, is it's really a transfer of risk, which you can't do for yourself. And what I mean by that is an annuity company is going to guarantee you specific payments for as long as you shall live. So you have zero investment risk. You have zero implementation risk. And the annuity company can potentially, and I'm not saying it happens this way, especially in the interest rate environment, offer you a more consistent, potentially higher payment than you might pay yourself. But what you give up for transferring that longevity risk and that execution risk is, well, access to your money when you annuitize. And there are some riders where you can have some inheritance and beneficiary, but I tend to agree with you in the sense that maintaining control of assets in the event that you need them and doing it yourself, you'll likely come out with a better outcome, but you're going to have to take on market risk and execution risk in assuming that you can execute consistently on how you invest even when you're 85. And you expose yourself to potentially some of the risks that we've talked about throughout the month. But I see your point, but it's really about transferring risk to an insurance company so you have that guarantee. What we got next?
So we have another question from an awesome listener that would prefer to remain anonymous. So yes, this is very mysterious. She writes in that she was listening to a recent podcast where you mentioned waiting until your 80s to turn on annuitization to manage longevity risk. She says, my husband bought a fixed single premium indexed annuity in 2016 at age 60, and we were told he would need to start taking income at age 70 because RMDs would be coming out at 70 and a half anyway. You didn't mention anything about RMDs being applicable. The funds that he used to purchase his annuity came from a tax-deferred supplemental retirement account that he had through work.
And that's the key right there, is annuities, if you're using after-tax money, generally aren't subject to required minimum distributions. But it sounds like your husband purchased an annuity within a tax-deferred account, monies that he had not paid tax on. So it's from an IRA or account perspective, they look at it just like any other investment, and the value is going to be included in that RMD calculation. So a couple things you can do is if you put all the money into the annuity, then yeah, you're going to have to take RMDs from some source by turning on the income. But if you have, I'm just making up numbers, if you have a $500,000 IRA and you put $250,000 of that IRA into an annuity, and then you turn 70 and a half, you'll have to use the value of the annuity and the rest of your IRA to calculate your required minimum distribution, but you don't have to take the RMD from the annuity. You could use your other assets. So it sounds like it was because it was within a tax-deferred account. So hopefully that helps you, awesome listener.
Our next question is from Tony. He wants to know, why is it that insurance companies issue annuities? Why not investment banks or retail banks? And then he wants to know, how does the issuer make money, especially with fixed annuities? How do they cover their risk? Couldn't we do the same?
Part one, because they're insurance companies and it's an insurance contract. And if you think of insurance, what are you doing? You're pooling risk in return for a guarantee from the insurance company. Retail banks and investment banks, regulatory-wise, and I'm not an expert in all those regulations, can't do that near as effectively, plus offer tax deferral and some of the other things in an insurance wrapper. And so that's how they've grown up, although leave it to investment banks. They're getting more creative all the time. Now, on your second part, how does an issuer of annuities make money, especially with fixed annuities? Well, in that sense, it's a lot like how a bank makes money. So if I'm an annuity issuer and I sell you an annuity, I'm paying you 2% for the $100,000 that you put into my annuity. Well, I have the use of your $100,000. And because I have thousands of contracts of individuals just like you, I have a big pile of money that I can invest, and I can make potentially the difference from the 2% that I give you on your money and what I'm able to earn with the use of your money. So that's how an insurance company makes money, just like how a bank makes money. Now, with an insurance company and fixed annuities, it's been really difficult because a lot of how they make money from a safe perspective is interest rates. And interest rates have been low for decades now. So the spread they can make by just paying you 2% and earning 3 or 4% in a bond, that opportunity isn't near as there as it has been historically. So insurance companies and banks, and for that matter, are hurting a lot. But that's how they make money. Now, why couldn't you do the same thing? Well, you sort of can, right? You can't get the benefits of guaranteed income, but you can go buy a CD rather than put it into a fixed annuity. You're just not going to get the extra benefit of that annuitization option. And that goes back to the thinking of, don't think of these things as investments per se, but as you're buying a pension or a guaranteed stream of income. That you can't do on your own near as easily as an annuity company can, because they're pooling the risk of everybody.
Elaine writes in, annuities sound so appealing. What would you say to someone who doesn't want to know the details of fees and charges of an annuity? They just want the guaranteed income. In what situations would you recommend an annuity?
You still got to know the fees and charges. Read the prospectus for sure.
Yeah, there's a lot of, I don't want to say gotchas exactly, but there's a lot of ways that you can accidentally break your contract with annuities if you take out more money than what they specify or things like that. Yeah,
there's a lot. I mentioned last week, the variable annuity prospectus that I looked at was 175 pages, right? So I get Elaine's inclination of, how am I supposed to read that? 1. 2, how am I supposed to understand that? Now, it does get a lot more simplified if we're talking about fixed annuities. They are much more straightforward than a variable annuity. And as long as you understand what the guarantees are, I can understand not having to really know all the ins and outs of these things. So fixed annuities are definitely a lot more simple to understand. And it is what it is, right? You put the money in, you understand the charges, you know what you're going to get paid. They're pretty straightforward. Now, in what situations would you recommend an annuity? I don't like to talk about when I would recommend something.
Don't take advice from him on the show.
On the show. And I'm not going to cop out here, though, because in my mind, if you follow a good process and come up with a strategy and you're collaborating, whether an annuity makes sense becomes self-evident as you're looking at different scenarios. So I like to let the process drive the decision making. But when you might want to consider an annuity, and I would say a fixed annuity of some sort, is when you are looking to ensure longevity risk, simplify your financial life, and think of it from the mindset, sort of like you've intimated here, that you are buying a pension, you're buying a stream of guaranteed payments, you're not buying an investment. Think of it from that mindset rather than thinking of it as investment money. And I think that will help you avoid a lot of the more complicated things where the real gotchas are.
Our last question is from Casey. Is there truth to the claim that some insurance companies are selling off their annuity lines because they feel they can't be profitable due to longer lifespans and the large volume of the aging baby boomer generation? If true, what are the potential ramifications?
So in my experience, Casey, the insurance markets in general are very fluid. So I think back to the early 2000s or late 1990s when we had a lot, I think it was black mold in Texas. So you had this huge thing about black mold and these huge claims against Nicole. You know what black mold is?
I vaguely remember some of this, but I was a teenager, so it wasn't
on your radar.
On my radar, big time, yeah.
So basically, there'd be some moisture in the walls, and this black mold would grow, and there'd be all these health effects as a result. So there was this huge amount of claims for black mold, so much so that the insurance companies that were insuring homes in Texas were getting slammed. And a couple of the big majors pulled out of writing any more policies in Texas because their claims, they had so much liability there because of all the claims against them. But at the same time, I think it was AAA, who was not in Texas, came into Texas. So they had none of the exposure. And then they came out with a vintage of a home insurance product that limited much more than the previous iterations of other insurance companies, the exposure to black mold. And so they were able to gain a lot of market share. And the reason I know this is because I went through this. I think my home insurance at the time went, I forget the exact numbers, from like $1,800 and then the renewal was going to be like $3,500.
Yikes.
So I went and shopped and ended up at the time going with AAA, which came in at like $2,100 because they were a new player and they didn't have any exposure. So I think the same type of thing happens with annuity companies, where you have certain annuity companies that will come in and out of the market of variable annuities or fixed annuities. And not only will you have some that will come in and out of the market, what you will have is they issue different vintages of policies. So let's say you have XYZ annuity and you bought it in 2010. That is going to be different than XYZ annuity in 2014 because each annuity has its own contract. So what happens with a lot of these is they'll just change the terms of the contract as they manage their assets and liabilities on it. So I think there's a lot of fluidity there. And it's interesting because I have some clients that have legacy contracts that are 10 years old. And these annuity companies will send them letters trying to buy them out of the contract because they want to get the liability away. So I think there's just a lot of fluidity, but there's such a big market there. And bluntly, there's so much money to be made that they go in and out. And I think when interest rates normalize, whatever that is, that will help as well. Hey, Nicole, with that, can we go get happy?
Let's go.
Hallelujah, 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 hallelujah.
Yay!
Why am I so happy, Nicole?
Because we're done with annuities.
We are done with annuities on the show. Now, I say that.
Hey, we have been talking about annuities and doing annuity podcasts for a long time. So this has got to be a good, we've knocked it out and we're done.
5-week month we did annuities.
We did.
Now, this does not mean that we're not going to come revisit them again because it's an important subject. that needs clarity. But come on, it's not that exciting.
Maybe next year? Yeah, I was going to say, do we have to do it again in 2019?
Not in 2019. But I am also very happy about next month, August, because we're going to talk about who are you? Who? Oh, I'm going to get those emails. Don't sing, Roger.
Sing it on the podcast again.
How do you figure out what your identity is in retirement? I'm excited about that. We got a great lineup. I think this may be...
We do. There's a lot of good interviews. Yeah.
This may be the best month we ever do to this point. I'm throwing the gauntlet down. I think this is going to be a good month. So let's go set a smart sprint.
On your marks, get set.
And we're off to set a 7-day smart sprint. I'm shortening it every time, Nicole, so we get this down right.
Sounds good.
So in the next 7 days, what I want you to do is eat the toad. Or it's the frog. Eat the frog. Eat the frog, Nicole.
Either way, it sounds unappealing.
So it's a book by Brian Tracy. I think it's called Eat the Frog. And it's about, there's always something that we try to avoid. A conversation, a task. And so we keep putting it off. And the book argues, do the hard thing first thing in the morning. First thing in the morning, get up, do the hard thing. The conversation you don't want to do, the medicine you don't want to take, just get it done. And it's all downhill from there. We all have something like that.
We do. So that's the frog?
Yeah, or the toad. I think it's the frog.
Okay. Some kind of amphibian.
There you go. All right, Nicole, we're going to work on this identity thing. I know you're very young, but you are still going to have to participate.
Okay, I can do that.
Okay. I'm excited for next month, guys. I hope you have a wonderful day.
We appreciate you joining us today for this episode of Retirement Answer Man. Be sure to visit rogerwhitney.com/answers to access the Retirement Answer Library with over 30 checklists to help you make the most of the only life you have. Remember, you have more power than you realize to create an amazing life starting today with Retirement Answer Man. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and no guarantee of future results. All indices are unmanaged and may not be invested into directly. Have a wonderful day.